You know, usually when we talk about getting a medical diagnosis, there's this underlying expectation of just like pure mechanical precision.
Right, yeah, like it's completely objective.
Exactly. You break your arm, you go to the hospital, and the x-ray shows that jagged white line on the screen. The doctor points at it and says, there's the fracture. It's incredibly binary. It's either broken or not broken.
Well, it's visible structural failure.
Yeah.
We rely on that visibility because, I mean, it gives us a clear path to fixing the problem. We actually want to see the mechanics of what went wrong.
But then you step into the world of finance, specifically, wealth management, and that expectation of visibility just completely vanishes.
Oh, it's gone.
You hand over a massive chunk of your life savings, maybe 50 lakh rupees or even more, to a portfolio management service, and you expect that same precision, a clear line of sight on how your wealth is being grown.
But there is no X-ray machine for the inner workings of a financial institution.
Right.
Right.
You are basically handing over the keys to a financial bulldozer, and you just have to trust that the person in the driver's seat isn't going to, drive it off a cliff, or worse, use it to rob a bank.
Which is, frankly, an incredibly vulnerable position for any investor to be in. I mean, when you wire those funds to a portfolio manager, you aren't just bidding on their ability to pick the right tech stocks or read a balance sheet.
Yeah.
You are entirely dependent on an invisible, heavily enforced architecture of rules. That architecture is like the only thing preventing your capital from being swallowed up by fraud or used to wash illicit funds.
Or bled dry by the unethical practices that human beings are tempted by when surrounded by vast sums of money.
Exactly.
And that invisible architecture is exactly what we're exploring for you, our listener, today. Welcome to this custom-tailored deep dive. We are looking at a very specific foundational set of rules.
Yeah, our source material today is the regulatory framework governing wealth managers in India, specifically the guidelines from the National Institute of Securities Markets, or NISM.
Right. And we're focusing on the dense but crucial details of Chapter 12 from their series XEIA workbook. This basically maps out the regulatory, governance, and ethical guardrails for portfolio managers.
It's essentially the blueprint of financial trust. And, while financial regulation often gets a reputation for being really dry, it's actually a deeply revealing study of human psychology.
How so?
Well, these rules didn't just fall out of the sky. They were written in direct response to historical scandals, massive market crashes, and some incredibly creative forms of theft.
Wow. Yeah.
Every single regulation we're going to look at is a countermeasure against the specific way human beings have tried to cheat the system.
Okay, let's unpack this, because to really understand how this protects you, the listener, we have to look at the vulnerabilities from the ground up. We're going to examine how the system catches dirty money right at the front door.
Right.
How it builds literal Chinese walls inside office buildings to stop gossip, and ultimately what legal rights you have as an investor.
It's a journey.
It really is. So let's start at that front door. Before a manager can even think about looking at a stock chart or planning an investment strategy for you, they have to verify that the money you are giving them is legally sound.
Yeah. That journey has to begin with the Prevention of Money Laundering Act, 2002.
The PMLA.
Exactly, the PMLA. This is the first and arguably most critical line of defense. The core philosophy here is that legitimate financial markets cannot, under any circumstances, be utilized as a laundromat for the proceeds of crime.
I mean, that makes intuitive sense, but how does a portfolio manager actually act as a security guard against money laundering? If a cartel or a corrupt politician wants to invest money, they aren't going to, walk into the wealth management office with the duffel bag full of cash.
Right, they aren't doing that anymore.
They're going to use shell companies, fake invoices, complex corporate structures.
And that is exactly why the PMLA imposes mandatory proactive checkpoints. Any intermediary registered under SEBI is legally obligated to implement exhaustive anti-money laundering policies.
So it's not just checking a box.
No, it's not just about collecting a passport copy. It involves rigorous client due diligence, or CDD. They have to unravel those corporate structures you just mentioned to find the ultimate beneficial owner.
Wait, so if a trust or a private company is opening the account, what do they have to do?
The portfolio manager has to literally drill down through the layers of ownership until they find the actual breathing human being who controls the funds. They have to understand the source of that wealth and the real nature of the client's business.
So the goal is to make it incredibly difficult to integrate dirty money into the clean market without leaving a massive paper trail.
The paper trail is everything. I mean, the PMLA dictates non-negotiable record-keeping requirements. Portfolio managers must maintain a comprehensive record of all transactions, client identities, account files, and even business correspondence relating to the clients.
Okay.
And here's the kicker. They must hold onto these records for a period of 5 years from the date of the transaction or the end of the business relationship.
I want to push back on that 5-year rule a bit. 5 years of holding every single piece of business correspondence for every single client. That seems like an administrative nightmare.
It is a lot of data, yeah.
Why not 2 years? Why not just keep the records of the actual trades and throw away the emails?
Because of the timeline of financial forensics, complex money laundering schemes, the ones involving multiple jurisdictions, offshore accounts, and layered transactions, they rarely get discovered in real time.
Oh, that makes sense.
Right. They often come to light years later during a broader criminal investigation or a random tax audit. If an enforcement agency discovers that a syndicate was washing money through a PMS back in 2022, they need the raw data to prove it.
Right. If the portfolio manager deleted the onboarding emails or the notes from client meetings after 2 years, the trail just goes completely cold.
Exactly. The 5-year window ensures that the forensic evidence remains intact, just sitting in a secure archive, ready to be reconstructed by investigators.
Okay, so that makes sense for the long game. It's an archival safety net. But what if the portfolio manager sees something actively suspicious happening today?
Like what?
Say a client who usually invests 10 lakh rupees suddenly wires 50 crores from an unknown offshore entity and instantly requests it to be moved into highly liquid assets.
Well, they're legally forbidden from ignoring that. The regulations mandate a strict reporting window. If a portfolio manager or their staff spots a suspicious transaction or even just a series of transactions that seem likely to involve the proceeds of crime, they must report it to the Financial Intelligence Unit, India.
The FIUIND.
Yes, and they must do this within 7 working days of establishing that suspicion.
7 working days. I mean, in an era where digital money and crypto assets can bounce across 3 continents in a matter of milliseconds, 7 days feels like an eternity.
I get that.
By the time day 6 rolls around, that 50 crores could be converted into untraceable bearer bonds or spread across thousands of decentralized wallets. Why give them a whole week?
It's a valid concern, but the 7-day window is a calculated balance. The goal of the FIUIND isn't just to receive panicked, half-baked alerts every time a client makes an unusual deposit.
They don't want spam, basically.
Exactly. They need actionable, structured intelligence. The portfolio manager needs a few days to actually analyze the transaction, compile the relevant KYC data, document the reasons for their suspicion, and format the report so that law enforcement can immediately act on it.
So if the window was 24 hours, the system would just be flooded with false positives.
Yeah, burying the genuinely criminal activity under a mountain of administrative noise, the 7 days forces the institution to be thorough rather than just fast.
And someone has to put their neck on the line for that thoroughness, right? There has to be a specific person held accountable if the firm fails to report this.
Oh, absolutely. Under the PMLA, the firm cannot just, diffuse the responsibility across a vague compliance department. They must designate a specific principal officer.
Principal officer, okay.
This individual carries the immense personal weight of ensuring the firm adheres to every provision of the Act. They are the point person who signs off on these suspicious transaction reports.
Wow.
If the firm is found to be willingly turning a blind eye to money laundering, the principal officer is the one answering to the authorities.
So when a new investor gets frustrated because opening a PMS account requires an endless stream of address proofs and tax IDs and declarations, they need to realize they aren't just dealing with bureaucratic red tape.
Right.
They are interacting directly with the friction intentionally designed into the national security apparatus.
It is intentional friction. If the system were perfectly frictionless, it would be a playground for organized crime.
So we've established the defenses at the front door. The money is verified, the client's identity is known, the funds are legally sound, but the threat doesn't vanish just because the money is inside the building.
No, it morphs.
Exactly. We move from worrying about external criminals to worrying about the people sitting right there in the office. How do the regulators prevent a wealth manager or their analysts from using confidential, unreleased information to enrich themselves?
This is the domain of the SEBI Prohibition of Insider Trading Regulations from 2015. Specifically, the regulations outline minimum standards for a code of conduct for intermediaries.
Right, to regulate and monitor trading by their own people.
Yeah, they're designated persons. The entire framework is built around containing what is known as unpublished price-sensitive information, or UPSI.
UPSI. You know, when people hear insider trading, they usually picture a CEO whispering a secret to a friend on a golf course.
Like in the movies.
Right. But for a portfolio management firm, it's more systemic. They might be managing funds for a corporate client, or their research desk might uncover data that isn't public yet.
It's asymmetrical information warfare, really. Think about it. If an analyst at the firm knows that a major pharmaceutical company's new drug trial just failed information that won't be released to the public until tomorrow, and they sell their personal shares today,
They're essentially cheating.
they are effectively stealing from the person on the other side of that trade. The buyer thinks they are purchasing a stable stock, completely unaware that the analyst is dumping a toxic asset onto them based on a secret.
And the regulations view this as a fundamental destruction of fair and equitable markets.
Totally.
But how do you practically stop that, though? The 2015 regulations mandate something called a Chinese wall. Now, human beings are incredibly social creatures.
They are.
We talk, we gossip, we share information almost involuntarily. In a modern office environment, especially with open-plan seating, shared cafeterias, or thousands of employees connected on a single Slack workspace, how does a Chinese wall actually function?
Well, it requires a severe structural segregation of information flow. A Chinese wall isn't just a corporate buzzword.
Right.
It's a heavily audited set of procedures designed to isolate departments that possess UPSI from those that trade on the open market. The regulations demand that information is handled strictly on a need-to-know basis.
So, if the investment banking arm of a financial institution is advising a company on a highly confidential merger,
The portfolio management arm of that same institution cannot have any access to that data.
what does that isolation look like mechanically? I mean, are there actual walls?
Well, it involves physical access controls, like certain keycards literally won't work on certain floors, but more importantly, it involves digital segregation. Servers are partitioned.
Oh, wow.
Yeah, document management systems are ring-fenced so that an analyst on the public market side literally cannot open the files generated by the private advisory side. They operate on entirely separate network environments.
But business isn't always that clean. What if a portfolio manager genuinely needs the expertise of someone on the restricted side? Say they need a complex tax structure analyzed by someone who happens to be walled off.
The regulations provide a mechanism for that, often referred to as crossing the wall. But let me tell you, it is treated like a hazardous material transfer.
Seriously?
Oh yeah. It requires formal documentation and the direct involvement of the compliance officer. The individual who needs to cross the wall must present a legitimate business reason.
And if it's approved?
If approved, the person being brought inside is formally briefed on the sensitive information, but they're also legally notified of the severe liabilities that attach to it. A log is created.
So there's a permanent record.
Exactly. The compliance officer now has a permanent record that this specific employee is contaminated with UPSI regarding a specific security.
Here's where it gets really interesting to me. Because the regulations don't just rely on restricting the information, they actively restrict what the employees can do with their own personal bank accounts.
Yes, the concept of preclearance.
Right. The Code of Conduct requires that designated persons, which includes portfolio managers, analysts, anyone likely to have access to sensitive data, they can't just open a brokerage app on their phone and day trade.
No, definitely not.
If they want to buy or sell a security above a certain threshold, they have to submit a formal request to the compliance officer to pre-clear the trade.
And the compliance officer is sitting there with a master list of all the secrets the firm currently holds. It's called the restricted list.
The restricted list, okay.
Yeah, it's a highly confidential internal database of securities where the firm is currently in possession of UPSI. When an employee asks to buy shares of Company X, the compliance officer checks the restricted list.
And if it's on there?
If Company X is on it, the trade is instantly denied, and no explanation is given to the employee.
Right, no explanation.
None. Because even explaining the denial could leak the fact that a major event is brewing. The employees are simply told they cannot trade that security.
Wow. Let's say the stock isn't on the restricted list and the trade is approved. Can the employee just, hold onto that approval ticket and wait for a market dip a month later to actually buy the stock?
No, the approval has a very short shelf life. The code specifies a reasonable time frame for execution, which cannot exceed 7 trading days.
7 days again.
Right. If the employee doesn't execute the trade within that narrow window, the pre-clearance expires entirely. The rationale is that the firm's information landscape changes constantly. A stock that is clean today might become restricted tomorrow.
So the 7-day limit ensures the trade happens while the compliance officer's assessment is still actually accurate.
Exactly.
Okay, that stops them from hoarding approvals. But what about opportunistic trading? Let's say an analyst gets approval, buys a stock, and 2 weeks later, the stock unexpectedly jumps 30% due to an unpredictable market event.
Okay.
Can they just sell it immediately and pocket the cash?
They cannot. This is governed by the contra trade rule, which is honestly a massive restriction on personal financial freedom for financial professionals.
How so?
The regulations state that a designated person who is permitted to trade in the securities of a listed company cannot execute a contra trade for a specified period, which cannot be less than 6 months.
6 months? Wait, really? That is a massive exposure to market volatility.
It is.
So if they buy a stock, they are legally barred from selling it for half a year.
Correct. And conversely, if they sell a stock, they cannot buy it back for 6 months. The rule is slightly relaxed for mutual fund units, where the restriction cannot be less than 2 months, but the underlying logic remains.
Which is what?
The regulators want to completely eliminate the incentive for short-term speculation by industry insiders. Portfolio managers should be focused on long-term value creation for their clients, not trying to scalp quick profits on their personal accounts based on short-term market momentum.
I mean, that makes sense on a macro level, but what if they have a personal financial emergency? What if the market crashes and they need to liquidate their assets to buy a house or pay for a medical procedure? Are they just trapped?
Well, the compliance officer can grant exceptions in cases of severe personal emergency, but the bar for that is incredibly high, and the reasons must be recorded in writing.
So they can't just say, I need cash.
No. Generally speaking, the lock-in is absolute. If you choose to work in this industry and handle client wealth, you surrender a significant amount of your own trading agility.
What happens if someone breaks that rule? Say they buy a stock, it spikes, they get greedy, and they sell it after 3 months anyway.
The profits from that illegal contra trade are subject to disgorgement.
Disgorgement, that's a fascinating legal term. It implies a forced extraction like pulling a tooth?
That's a good way to put it because it is entirely punitive. The individual is forced to surrender every rupee of profit they made from the violating trade.
Oh, wow. Does it go back to the firm?
No, the money doesn't go back to the firm, and it doesn't just disappear. The regulations stipulate that the disgorged funds must be remitted to SEBI,
Okay.
specifically for credit to the Investor Protection and Education Fund. The illicit gain is repurposed to build resources that educate the public and protect them from financial predators.
That's actually brilliant.
And that's just the regulatory penalty. The firm's internal code of conduct will trigger its own sanctions, which routinely include wage freezes, suspension, and clawbacks of previous bonuses.
The power wielded by the compliance officer in this scenario is staggering. I mean, they control the financial autonomy of everyone in the building,
They really do.
which leads to an obvious structural vulnerability. If the compliance officer is an employee of the firm, drawing a salary from the firm, what happens if the CEO is the one engaging in insider trading?
The classic problem.
What stops a corrupt executive from simply walking into the compliance officer's office and threatening to fire them if they don't approve a shady trade?
The architects of these regulations anticipated that exact power dynamic. To protect the integrity of the oversight, the regulations hardwire the compliance officer's reporting lines to bypass standard management hierarchies.
So they don't report to the CEO.
The compliance officer does not report to the CEO or the head of a specific trading desk. They are mandated to report directly to the board of directors and specifically to the chairman of the audit committee.
That is a crucial defense mechanism. It means the person guarding the secrets has a direct, protected channel to the ultimate governing authority of the company. It neutralizes the threat of a rogue middle manager or a corrupt CEO.
It provides the psychological safety necessary for a compliance officer to actually do their job without fear of direct career retaliation.
Okay, so we've covered the hidden secretive threats, money launderers trying to sneak in, and insiders trying to sneak data out.
Right.
But not all financial crimes are committed in the shadows. Some of the most destructive acts are performed in broad daylight right on the open market, specifically to trick everyone watching. Let's look at market manipulation.
This brings us into the territory of the SEBI prohibition of fraudulent and unfair trade practices relating to securities market regulations, 2003.
That's a mouthful.
It is, usually just called the FUTP regulations. But this framework deals with the illusionists of the financial world.
Right, because insider trading works by withholding information. But market manipulation works by actively broadcasting false information.
Exactly.
It's about engineering a fake reality to trigger a real reaction from other investors. The regulations have a very specific legal definition for fraud here, don't they?
They do. It defines fraud as any act, expression, omission, or concealment committed to induce another person or their agent to deal in securities. The key word is induce.
Induce, okay.
The entire goal of the manipulator is to trick you into buying or selling a security that you otherwise wouldn't have touched by creating a completely artificial scenario.
I always try to visualize this outside the context of a stock ticker. Imagine you're walking down the street looking for a place to eat. You see a brand new restaurant, but it's completely empty. You'd probably walk right past it.
Sure. Now imagine the owner of that restaurant hires 50 people to stand outside the door, forming a massive noisy line, pretending they are desperate to get in. You walk by, see the crowd, and your brain instantly assumes this must be the most incredible food in the city.
Yeah, social proof.
You get in line and pay for a meal. The restaurant owner didn't force you to buy the food, but they engineered a fake appearance of demand that induced you to part with your money.
That is the exact psychological exploit targeted by the 2003 regulations. In the context of a portfolio manager or a trader, one of the most common ways to build that fake line outside the restaurant is through artificial trading volume.
Okay, but how do you fake volume? A trade requires a buyer and a seller, and real money has to change hands.
The most notorious method is circular trading, which the regulations define as dealing in a security not intended to affect transfer of beneficial ownership. Let's say you, me, and a third colleague decide to manipulate a highly illiquid penny stock.
Okay, I'm listening. I sell 100,000 shares to you at 10 rupees. A minute later, you sell those exact same shares to our colleague at 10 rupees and 5 paise. 10 minutes later, the colleague sells them back to me at 10 rupees and 10 paise. We run this loop hundreds of times throughout the trading day.
So no one is actually acquiring a meaningful stake in the company. We are just passing the same parcel around in a circle.
Precisely. But think about what the market sees.
Yeah.
An algorithmic trading bot or a retail investor looking at a screen sees a stock that was completely dead yesterday suddenly trading millions of shares today with the price ticking steadily upward. They see the massive line outside the restaurant.
The artificial volume triggers momentum algorithms. Retail investors jump in due to FOMO, and the price spikes to, let's say, 15 rupees.
At that point, the three of us dump our original shares on the unsuspecting public, pocket the profit, and walk away.
And the stock plummets back to 10 rupees, and the real investors are left holding the bag.
Yep. That highlights why the regulations specifically prohibit dealing in a security intended to operate only as a device to inflate, depress, or cause fluctuations in the price.
But volume isn't the only thing they fake, right? They also manipulate the fundamental data of the companies themselves.
Oh, yes. The regulations outlaw knowingly publishing or reporting any information relating to securities which is not true, or which the person does not believe to be true.
So, rumors and lies.
Basically. This covers a massive spectrum of deceit. It means a corporate executive cannot release a fabricated financial statement showing record profits just to pump the stock price. It means a portfolio manager cannot spread a baseless rumor that a company is about to secure a massive government contract.
If we connect this to the bigger picture, why is the regulator so fiercely aggressive against this specific type of behavior? Obviously, lying is bad, but why dedicate such a complex regulatory apparatus just to stop people from playing games with volume and rumors?
Because true price discovery is the oxygen of the financial markets. The fundamental promise of a stock exchange is that the price you see on the screen represents the collective consensus of all available public information regarding that asset's value.
Right. Millions of buyers and sellers interacting freely to find the true price.
Exactly. If you introduce artificial volume or spoof the benchmark prices or inject fake financial data into the ecosystem, the mechanism of price discovery breaks down entirely.
The price just stops reflecting reality.
And the moment investors realize that the prices on the screen are fictions engineered by manipulators, trust evaporates. They will pull their capital out of the market entirely. Without trust in price discovery, the entire financial ecosystem collapses.
I want to challenge how you actually enforce this, though. You mentioned the definition of fraud relies heavily on the intent to induce. How does SEBI prove intent?
It's not easy.
Right, if I buy 1 million shares of a stock and then change my mind an hour later and sell them, creating a massive fluctuation. How does the regulator prove I was trying to manipulate the market rather than just executing a chaotic trading strategy?
Proving intent is definitely the most difficult aspect of securities litigation, which is why enforcement agencies rely heavily on data pattern analysis.
Right, okay.
They don't just look at one trade. They look at the historical behavior of the trader,
Hmm.
the synchronicity of the buy and sell orders, and communication records. If they see that you placed a million-share buy order, but simultaneously place a million-share sell order at the exact same price through a different broker,
Then it's obvious.
yeah, the data itself betrays the intent. There is no legitimate economic rationale for trading against yourself other than creating artificial volume.
So the data leaves a footprint that the manipulators can't erase. Wow. Okay, we have spent a lot of time in the criminal underbelly. We've talked about money laundering, insider trading, and market manipulation. Let's pivot to the day-to-day reality of a law-abiding wealth manager.
A slightly lighter topic.
Just a bit. Even if a portfolio manager has flawless integrity, they still possess enormous power over their clients' money. The regulator cannot just rely on their good character, they have to build operational guardrails.
This brings us to the SEBI Portfolio Managers Regulations 2020. This is the operational rulebook. It dictates the mechanics of how the firm must be structured and exactly what they can and cannot do with the capital entrusted to them.
Our outline notes that the very first operational rule is about ensuring the firm has sufficient skin in the game.
Correct. You cannot just rent a cheap office, print some business cards, and declare yourself a portfolio manager. You must hold a certificate of registration granted by SEBI.
And a core condition of maintaining that certificate is maintaining a specified minimum net worth at all times. We know from other parts of the NISM materials that an individual investor needs a minimum of 50 lakh rupees just to open an account with a PMS. But this net worth requirement is for the firm itself. Why does SEBI care how much money the firm has in its own bank account as long as it's managing the client's money well?
Because a financially unstable portfolio management firm is a systemic risk. The regulators want to ensure that the firm has the financial ballast to survive market downturns, pay its staff, maintain its cybersecurity infrastructure, and operate its compliance departments.
So they aren't tempted to cut corners.
Exactly. Or worse, be tempted to dip into client funds to keep the lights on. It proves they are a serious capitalized entity capable of absorbing the operational costs of managing wealth.
Let's talk about the physical reality of the client's money. If I wire my 50 lakhs to a portfolio manager, where exactly does it sit? Is there just one massive corporate bank account labeled client funds?
Absolutely not. And this is perhaps the most critical operational safeguard in the entire framework. Strict segregation of assets.
Segregation.
The regulations mandate that the portfolio manager must keep the funds of all clients in a separate account maintained in a scheduled commercial bank. Furthermore, they must segregate each client's funds and portfolio of securities, keeping them entirely separate from the firm's own capital.
So they cannot commingle the funds.
Zero commingling. They cannot use the cash sitting in your portfolio to pay the firm's lease, and they cannot pool your money with another client's money to negotiate a better block trade price, unless explicitly structured to do so under specific exemptions.
That makes a lot of sense.
And even more importantly, the portfolio manager cannot hold the securities belonging to the portfolio account in its own name. The assets must be held in depository accounts that clearly identify them as belonging to the respective clients.
This sounds like a bankruptcy protection mechanism.
That is exactly what it is. If the portfolio management firm makes terrible corporate decisions and files for bankruptcy, the firm's creditors cannot come after your stocks to settle the firm's debts.
Oh,
Because the assets are segregated and held in your name, they are legally insulated from the firm's corporate liabilities. Your portfolio simply gets transferred to another manager.
okay, so the money is safe from bankruptcy. Now, what are they actually allowed to buy with it? I mean, the appeal of a PMS is that they have access to sophisticated strategies, but surely they can't just take my retirement fund and invest it in an underground art syndicate.
No, definitely not. The regulations place strict investment limits based on the nature of the service and the profile of the investor. For a discretionary portfolio manager, where the manager has the authority to make day-to-day buy and sell decisions, without asking for your approval on every trade, they are largely restricted to transparent regulated markets.
Like what?
They must primarily invest client funds in securities listed or traded on a recognized stock exchange, money market instruments like commercial paper or treasury bills, and units of mutual funds.
So they're mostly confined to assets that have daily liquidity and public price discovery. But what about the private markets? Unlisted startups, private equity, debt in companies that haven't gone public.
This is where SEBI introduces a fascinating sliding scale of risk allowance. If the portfolio manager is offering non-discretionary or advisory services, meaning they advise, but the client makes the final decision, they are permitted to invest up to 25% of the client's assets under management in unlisted securities.
Okay, a 25% cap keeps the majority of the portfolio in liquid, transparent assets. But our outline highlights a major exception to this rule.
Yes. The regulations state that a portfolio manager may invest up to 100% of the assets under management in unlisted securities if the client qualifies as a large value accredited investor.
Wait, 100%. So what does this all mean? Why does the regulator impose a strict 25% limit on a client who has 50 lakhs to invest, but allows an ultra-wealthy accredited investor to put their entire portfolio into unlisted private assets? It feels like a double standard. Shouldn't the regulator protect everyone equally?
I get why it feels that way, but it's not about unequal protection. It's about acknowledging the reality of financial capacity and risk comprehension. Unlisted securities are inherently opaque and highly illiquid.
Right.
If a private startup fails, you lose everything. If you suddenly need cash, you cannot quickly sell shares of an unlisted company because there is no public exchange for them. You might be locked in for a decade.
So it's extremely risky.
Extremely. The regulator acts as a paternalistic protector for retail investors, ensuring they aren't lured into catastrophic concentration risk. They assume that a large value accredited investor possesses the financial sophistication to understand those extreme risks, employs independent legal and tax advisors, and crucially, has the raw capital to absorb a total loss without it destroying their standard of living.
Ah, they are allowed to take the massive risk because they can survive the massive failure. That makes sense. Now, another way people take massive risks is by using leverage. Can a portfolio manager borrow money on my behalf to amplify the returns? Say they see a great opportunity and want to take out a loan against my current portfolio to buy more stock?
Emphatically no. The regulations are crystal clear. The portfolio manager shall not borrow funds or securities on behalf of the client. Furthermore, they cannot leverage the portfolio of its clients for investment in derivatives.
So they are restricted to investing the actual cash I provided.
Exactly. They also cannot lend the securities held on behalf of the clients to a third party, unless the client has explicitly authorized participation in a regulated securities lending and borrowing mechanism.
Okay, so the manager is confined to the sandbox of the cash I actually gave them. How do I verify they're following all these rules, though? Am I just supposed to trust them for a year and hope for the best?
Trust is verified through mandated, granular reporting. The portfolio manager must furnish a comprehensive report to the client at least every 3 months.
Every 3 months. Okay.
And this isn't just a high-level summary showing a percentage gain or loss. It must detail the exact composition and value of the portfolio. It must list every single transaction undertaken during the periods where the date, the security, the buy price, the sell price.
That is a massive data dump.
It's designed to provide absolute visibility. The report must also detail all beneficial interest received, like dividends or bonus shares. It must itemize every expense incurred in managing the portfolio.
Wow, every expense.
Yes, it must even highlight the details of the risk foreseen by the manager, including any default in payment of coupons on debt securities. It leaves no dark corners for the manager to hide poor performance or excessive trading fees.
And what if I receive that 3-month report, look at the trades, and realize the manager's strategy completely misaligns with my goals? Am I locked into a multi-year contract?
No, the regulations protect your right to exit. The funds or securities can be withdrawn by the client before the maturity of the contract. The client has the right to voluntarily terminate the portfolio management services.
Can they charge me for leaving early, though?
The firm is allowed to charge an exit load to cover the disruption of early withdrawal, but SEBI strictly caps these fees to prevent them from being used as a punitive trap. For example, a maximum of 3% in the first year, scaling down to 0 after 3 years. The manager cannot hold your capital hostage.
There's one more operational rule I want to dig into before we move on because it seems to address a massive potential conflict of interest, the related party rule.
Ah, yes. This is a vital protection against corporate self-dealing. The regulations dictate that a portfolio manager may make investments in the securities of its related parties or its associates only after obtaining the prior consent of the client.
Walk me through a scenario where this rule prevents a disaster.
Sure. Imagine a massive financial conglomerate. They have a highly successful portfolio management division flush with client cash, and they also have a separate real estate development division that is currently failing.
Okay, I see where this is going.
They issued bonds to fund a commercial skyscraper, but the project stalled, and no one in the public market wants to buy those risky bonds. Without the related party rule, the executives at the conglomerate could easily direct the portfolio manager to use the client's money to buy up the worthless debt of their own real estate division.
So they would be using the client's wealth to secretly bail out their own bad corporate decisions. The client takes on all the risk of the failing skyscraper, and the conglomerate saves itself from bankruptcy.
Exactly. It's the ultimate violation of fiduciary duty. To stop this, SEBI demands that prior positive consent must be obtained. The client must be explicitly informed that their money might be invested in the manager's associate companies.
Can the client say no?
Yes. The consent document must clearly offer the client the option to indicate dissent, to completely veto any related party investments. And the manager cannot derive any direct or indirect benefit out of the client's funds. Every action must be solely for the benefit of the investor.
It's a remarkably tight web of operational restrictions, but, here is the practical reality for almost every investor. You never actually meet the portfolio manager.
Rarely, yeah.
The person doing the quantitative analysis and executing the trades is sitting behind a bank of monitors in a secure room. The person the investor meets, the person who convinces them to hand over 50 lakhs, is the distributor. They are the sales force.
Right.
How does the regulator control the people on the front lines who are pitching these complex products?
This brings us to the final layer of the architecture. The frontline defense involves the code of conduct for distributors and the empowerment of the investor through the investor charter. SEBI recognized that the point of sale is the moment of highest vulnerability for the investor.
Because that's where the pitch happens.
It's where mis-selling, exaggerated promises, and high-pressure tactics are most likely to occur. To enforce accountability, any person or entity involved in distributing these services must obtain registration with the Association of Portfolio Managers of India, or APMI.
So the sales force is centralized and credentialed. What rules govern their behavior in a sales pitch?
The APMI Code of Conduct places strict boundaries on how a distributor can operate. They must consider the investor's risk profiling and financial suitability. A distributor cannot legally pitch a high-risk, aggressive small-cap strategy to an 80-year-old retiree living on a fixed income, simply because that strategy pays the distributor a higher commission.
That makes sense.
In fact, the code dictates that the commission or incentive shall never form the basis for recommending a specific portfolio management service.
That is a fascinating psychological paradox. The distributor is a salesperson sitting across from a potential client trying to sell them a wealth-building service. The client wants to know how much money they're going to make. But the code of conduct strictly prohibits the distributor from assuring returns or making any kind of guaranteed promises.
Yes, they must explicitly abstain from assuring returns in any investment approach.
So they have to look the client in the eye, ask for their life savings, and simultaneously declare, I cannot guarantee this will actually make you wealthy. You aren't buying a guaranteed financial outcome. You are buying trust in a heavily regulated process.
It is a unique sales environment that forces transparency. The distributor must fully explain the disclosure document, the specific investment approaches, and every single fee and charge that will hit the account.
No hidden surprises.
Right. They are also prohibited from using unethical means to attract clients, like offering under-the-table rebates, gifts, or kickbacks, and they cannot resort to making negative, unsubstantiated statements about competing portfolio managers. The pitch must rely on the merits of the firm's transparent track record.
Okay, so the distributor is bound by a code of conduct. But what tools are given to the investor to ensure these promises are kept? Our outline mentions the investor charter.
The investor charter for portfolio management services is an incredibly powerful document. SEBI mandated its creation to consolidate all the rights of the investor and all the responsibilities of the manager into one single, accessible framework.
So every client gets this.
Every registered portfolio manager must notify their clients about the charter and display it prominently on their website.
What does the charter actually do, though? Is it just a generic vision and mission statement, or does it have teeth?
Oh, it has sharp operational teeth. Yes, it includes the vision and mission. But its true power lies in the estimated timelines for services. It transforms vague promises of good customer service into legally enforceable deadlines.
Interesting.
The charter explicitly states how many days the firm has to open a new account, how quickly they must process a request to change a nominee, how fast they must upload KYC data to the central registry, and the exact deadlines for issuing those comprehensive 3-month balance statements.
So if a client submits a form to change their beneficiary, the firm can't just leave it sitting on a desk for 6 months. They are bound by the timeline in the charter.
Exactly. And if they fail to meet those timelines, or if any other dispute arises, the charter outlines a rigid grievance redressal mechanism. The portfolio manager is legally required to take adequate steps to resolve any client complaint within 21 calendar days.
21 days. And what if the manager just ignores the complaint or gives an unsatisfactory answer after 21 days? Does the client have to hire an expensive lawyer and go to civil court?
No, the regulator has built escalation pathways. The client can escalate the issue directly to the regulator through the SEBI complaints redress system, known as SCORES. It's a centralized web portal where the regulator steps in to oversee the resolution.
That's convenient.
And if the issue remains unresolved, the new architecture introduces an online dispute resolution mechanism, or ODR. This system harnesses conciliation and arbitration administered by market infrastructure institutions, providing a streamlined, binding resolution process that doesn't require decades of civil litigation.
There is one specific right embedded in this process that I find incredibly empowering for the individual: the negative list.
Yes, the right of the investor to create a negative list of securities. This is a brilliant feature of the regulatory framework. When a client signs the initial agreement and fills out the account opening form, they have the absolute right to explicitly forbid the portfolio manager from investing in certain stocks or sectors.
Even if it's a fully discretionary portfolio where the manager normally makes all the decisions?
Even then, the client retains ultimate veto power over the destination of their capital. This is crucial for investors who have strict personal, ethical, religious, or cultural boundaries.
So if I don't want to invest in, say, weapons manufacturing.
Right. If an investor fundamentally objects to companies that manufacture weapons, produce tobacco, or have poor environmental records, they put those sectors on the negative list. The portfolio manager is legally bound to respect those boundaries, even if the manager believes those stocks would generate massive returns. It ensures that the client's wealth is never used to fund activities they find morally objectionable.
That basically brings us full circle. You hand over the keys to the financial bulldozer, but you retain the right to draw a map of the roads the driver is never allowed to take. This has been a massive journey through the architecture of financial trust. For you, the listener, the next time you are opening an investment account and you feel frustrated by the seemingly endless KYC forms, the strict identity verification, or the complex disclosure documents you have to sign, I hope you view it differently.
Yeah, it's not just paperwork.
Exactly. You aren't just navigating corporate bureaucracy. Every form, every timeline, and every restriction is a load-bearing pillar in an invisible shield designed exclusively to protect your capital from criminals, manipulators, and the self-interest of the people managing your wealth.
It is a deeply human system. Every rule we discussed, the 5-year data retention to catch launderers, the physical Chinese walls to stop office gossip, the 6-month lock-in to prevent greedy speculation, and the strict related party consent forms, they are all engineered to manage the flaws, the temptations, and the darker tendencies of human nature.
Which brings me to a final thought I want to leave you with,
Yeah.
something to consider as we look to the future. We have spent this entire deep dive examining a rule book written to constrain human behavior. But the financial markets are no longer exclusively human.
No, they certainly aren't.
We are rapidly entering an era where AI algorithms, high-frequency trading bots, and machine learning models process unstructured data in microseconds. They execute millions of decisions before a human compliance officer can even log into their computer. So how does this architecture adapt?
That's the big question.
If an autonomous AI, optimizing for maximum portfolio return, mathematically decides to execute a pattern of circular trading that inadvertently creates false volume, who committed the fraud? Is it the programmer who wrote the code, the CEO who approved the software, the AI itself? How do you enforce a 6-month contra-trade rule on an algorithm that adapts its entire worldview every millisecond?
It is the ultimate frontier for regulatory governance. The core intent of Chapter 12, protecting market integrity, enforcing transparency, and ensuring true price discovery, will remain absolute. But the mechanical application of these rules will have to evolve to police silicon as effectively as it currently polices human psychology.
It is definitely something to watch closely as the markets evolve. We want to thank you for joining us on this deep dive into the NISM framework. We hope we have illuminated the invisible rules that guard your wealth, and we wish you a secure, transparent, and well-informed journey in all your future investments. Keep digging deeper.